Good day and welcome to the Anode Grade Petroleum Coke Market Outlook. My name is Justin Hughes. I work for CRU and I run the Aluminium Raw Materials team here. Today, Crew will be providing a deep dive into the supply and demand dynamics within the Anode Grade Coke market, highlighting the dominance of Chinese green coke importers in the third-party low-sulfur green coke merchant marketplace. We'll also examine the future demand profile and how the move towards cleaner energy will influence the aluminium and anode grade coke industry over the medium term. We're going to start with the economic overview and its impact on global demand profiles, acid allocation, and then also the aluminium production outlook, which ultimately drives anode production and sponge coke consumption utilization rates. CRU is an international research company. We do have specializations within the metals mining and fertilizer industry. The Crew Aluminium team has over 20 analysts across the globe, and that is focusing on primary products and raw materials. So here's the structure of today's presentation, and any questions can come at the end, either in the live Q&A or directly afterwards. So from an economic standpoint, over the past few months, we've received good news on the outlook of the world's two largest economies, a US stimulus package that was larger than expected, and economic growth in China that was stronger than expected. We expect a temporary rise in inflation in 2021 to reflect A, higher energy prices now compared to the lower prices of 2020, and B, a surge in spending as pent-up demand is released when lockdowns end. Looking further out, our view is that inflation will fall back towards central bank targets. Bond markets are less sure, however. They fear higher inflation and are uncertain with the path towards normalizing monetary policy. The path to global recovery seems more durable with each passing month. However, risks do remain. For China, they released their 14th five-year plan between the 5th and the 11th of March this year. It sets some ambitious innovation targets, but modest environmental targets. With the virus under control and a robust recovery underway, the message from China's two sessions meetings this year was one of policy normalization. Monthly economic indicators showed that the pace of China's economic growth increased at the beginning of 2021. As expected, industrial production has successfully achieved a V-shaped recovery that is supported by the recent export boom and quicker than normal return to work after the Lunar New Year. So the CRU macro themes, here we have 2021 will be a year of hope for recovery after the coronavirus pandemic left its mark on the world in 2020. Monitoring the speed and nature of the recovery will be vital to understanding all markets. Drawing on conversations between market experts and people across the commodity value chain, CRU expect interest in three topics to intensify and dominate the conversation this year: carbon emissions abatement, China's five-year plan, and how policy will reshape global trade. Now on to the aluminium market outlook and themes. The aluminium three-month price will rise to around $2,500 per tonne in Q4 of 2022. The price rally will continue on global tightness and a growing consensus that China is limiting supply and prices need to rise further to deliver sufficient production. The Shanghai Futures Exchange aluminium price will continue to trade at a large premium to the 90th percentile of Chinese operating costs. This is a major break to the relationship over the last decade or so. We've upgraded global demand by a cumulative 4.8 million tonnes from 2020 to 2025 and upgraded production by a much smaller 0.9 million tonnes, leaving stocks at 51 days of consumption by 2025, down from a forecast of 81 days in our previous report about 3 months ago. China will stay as a net importer of primary aluminium in every year of the forecast. Chinese semi-finished product export growth will fail to recover to 2019 levels as the high SHFE price relative to the LME impacts export profitability. We will see little risk that Chinese supply will exceed our forecast, but there is a significant risk that output could be lower. While China has the capacity ceiling, provinces may struggle to near that limit as they come under pressure to reduce their energy consumption and emissions from the aluminium smelting process. Directly because of these policies to reduce energy usage, we've lowered our 2021 Inner Mongolia production forecast by nearly 500,000 tonnes from our previous report as these policies are implemented. Emission reduction may mean China never achieve the 42 million tonne per year output forecast. China has dominated the aluminium market for the past 20 years, and the magnitude of its impact will not change in the next 5 years. In the accompanying chart, we detail the 5-year period defining themes of the modern aluminium market. The expectation that China would be structurally short of metal drove prices higher before the financial crisis. High prices resulted in supply growth in places such as the Middle East, but most importantly in China. Chinese exports of semi-finished and finished products also surged. That oversupply in China from aluminium smelting to rolling and extrusions defined the years from 2011 to 2018. Supply-side reform in China set a capacity ceiling, which seemed aspirational rather than restrictive for the industry. But robust demand has changed that. Additional production is needed globally, and it will not be all built in China. Although market speculators are concerned over rising curtailments in China related to China's new sustainability goals, CRU believes it will not struggle to achieve its climate ambitions. Instead, utilization for the rest of the world has hit the highest level since the global financial crisis. We include 3 million tonnes of additional production in the forecast for world ex-China, and that includes 1.5 million tonnes from uncommitted projects. The LME aluminium 3-month price will need to remain above $2,200 this year to ensure that production that is required to meet this demand is sustained. Without Chinese investment in the picture, however, the benchmark will persist above $2,000 in real terms to deliver additional supply. Production in China will grow by 7% year-on-year in 2021, primarily driven by ramp-ups in Yunnan and a year-on-year impact from plants that ramped up in Inner Mongolia in 2020. Production outside of China will increase by 4%, led by brownfield plants in Malaysia and India and restarts in South America. China's ability to build capacity at almost a quarter of the price of the rest of the world has been a major factor in driving incentive prices lower by 20% in the last decade. With supply-side reforms in place, limiting any further capacity expansions, the market can no longer rely on China to fill the order for demand. The place where investments are attractive, at the lowest LME price ex-China in Southeast Asia at an incentive price of $1,960 a tonne. This market holds strong potential for investment, especially considering the hydropower potential in Indonesia, Malaysia and Vietnam, and a better likelihood than elsewhere of being able to build new coal-fired power stations. Chinese companies have already stated they're interested in investing here, but a smelter with a 25-year lifespan supported by coal-fired power generation will have a progressively less receptive market to sell into due to emissions legislation. So this is starting to look at the importance of the aluminium market and the electrification of the global economy. Environmental policies to control carbon emissions are climbing up the policy agenda and have led to a surge in electric vehicle sales. This is having a major impact on the aluminium industry, creating opportunities for aluminium producers to dominate the battery casing market. Battery casing includes all aluminium used in the battery pack, plus the protective housing. CRU expect by 2025, global electric vehicle battery casing demand will rise to 1.4 million tonnes of aluminium, up from just 0.1 million tonnes in 2015. CRU expects EVs to account for over 25% of total sales by 2027 and over 50% by 2034. Aluminium intensity is higher in larger batteries. BEVs have undergone major changes. With improving battery technology, there's been a shift towards larger, more powerful batteries. These batteries have more cells, more energy, larger casings, making them very aluminium intensive. This is good news for aluminium producers. We therefore forecast that between 2020 and 2025, BEVs, batteries, will continue to become larger, more powerful, will continue to absorb more aluminium. As EV production increases, we forecast a steep rise in aluminium demand from this sector. Based on regional vehicle sales data, we anticipate that aluminium demand from EV batteries will grow to around 30% CAGR between 2020 and 2025, reaching nearly 500,000 tonnes in Europe and nearly 300,000 tonnes in North America by the end of the forecast period. So this slide just highlights the importance of the green premium and the fact that the market is now looking at the idea of a low carbon aluminium contract. Certain large producers such as UC Rusal and Alcoa are highlighting their green credentials, and that's not just to do with the actual aluminium process itself, but also to do with the exposure to the freight market, the bauxite mining, the alumina refining, the power usage for aluminium smelting, and the carbon anode itself, which will be discussed later on. This is part of the emissions story, but it's also impacting all metals and commodity markets at the same time. So where do primary aluminium producers stand? Well, many primary producers create the energy in-house, so they'll not have to purchase it, making the share of Scope 2 emissions smaller. Scope 1 direct emissions on average account for 44% of total emissions for primary producers, owing to the contained nature of the sector. Many of these come from internal production facilities and machinery. Primary producers also have extensive transport emissions from trying to get their products to rollers or extruders, and emissions from fuels which are used to power their operations. All this adds to Scope 3 emissions, which are significant. So where do primary producers go from here? Well, given nearly 50% of all emissions come from internal operations and machinery, the next step for primary producers is building cleaner and more energy efficient operations. Focusing on cutting down on fossil fuels, shifting to use of renewable sources will enable producers to cut on Scope 1 and Scope 3 emissions. Transport routes can also be optimised, and this will bring down the general cost. So one thing that's got talked about a lot recently, particularly with industrial metals, is the idea of a commodity super cycle and the impact that that's having not just on the price, but on investment. This is the CRU view on the super cycle and its impact on the aluminium market. In general, commodity prices have risen sharply in 2020 to 2021. Some commentators have called this a super cycle. Fundamentals and sentiment suggest that this year we will see elevated margins for steel and aluminium, other base metals and fertilizer products. But we do not believe it signals a new super cycle. Terminology is key here. A super cycle is a multi-decade phenomenon and not something that's simply established within a single year. So we see that there's little evidence that we're on the foothills of a super cycle boom, but some of the conditions to nurture a future super cycle can be put in place over the next 5 years. But what is a commodity super cycle and how long does it last and what defines its stages? For us, it comes in 3 distinct stages. We have temporary price spikes for lasting 1 to 3 years. These are caused by temporary shortages in stocks and supply disruptions or sudden bursts in demand, often referred to as business cycles. Long-run pricing trends lasting 5 to 20 years, peaks and troughs in pricing determined by supply and demand, ultimately moving towards an industry long-run marginal cost. And then the third type of commodity price move is a super cycle, typically lasting longer than 20 years. They're normally caused by many years of low investment, insufficient capacity and historically low prices. A shift in environmental and political factors holding back effective supply and a large and persistent step up in demand further support super cycles. So what about aluminium? Is this temporary or a long-term influence? Well, rising aluminium prices are primarily driven by a rapid demand rebound in China. The strength of Chinese demand in 2020 led to a massive shift in Chinese aluminium trade. Last year, China's net imports of primary aluminium, scrap and secondary ingot were 2.7 million tonnes, up nearly a million tonnes year on year. The Shanghai aluminium price rallied 50% from the lows of Q1 2020 and continue to rise to this day. Typically, the level of profitability would spur a massive increase in production. However, this did not happen in 2020, as the government's supply-side reform limited the ability for primary aluminium producers to lift their output. The combination of Chinese demand rebounding, Chinese increasing imports, and a sluggish response from producers to increase output lifted aluminium prices. But again, these are likely to be fairly temporary factors that will correct over the long term. So what is needed to trigger a new super cycle? For aluminium, the super cycle looking forward would need demand for aluminium from renewable energy and electric vehicles to be the key source of growth over the next 5 to 10 years. But it will only account for a small proportion of consumption by 2025. So we'll need to see some improvements there. Capacity constraints will arise in China by 2023. But by that stage, we forecast that Chinese companies will start to construct smelters in places such as Indonesia. These new plants outside of China will be built at a lower capex than typical plants. Ultimately, a domestic Chinese capacity constraint will result in deflationary capex ex-China. And thirdly, aluminium is notably a highly power-intensive commodity. China may restrict output more substantially than we forecast. In addition, carbon costs may spiral in the rest of the world, and new coal-powered smelters may fail to secure financing. So the bull case is that if this occurs and the move towards EVs and renewable energy happens faster than we anticipated, then that may well push us into that sort of realm. Certainly, ESG undoubtedly holds the most potential to push markets into a new super cycle. This could increase production costs, tighten supply, and boost demand, but we're still at the early stages of this green transmission. The technologies and associated costs that will take this world into a new environmentally conscious chapter are yet to be proven. And even if this is successful, it's unlikely that there will be a significant demand shift as China modernization demand pushes. Okay, so let's now have a look at the anode grade green and calcined coke market. Certainly since the last RefComm conference, we've seen continued pressure in the Chinese domestic ex-works market for all grades, from the lowest sulfur, less than 0.5%, all the way up to the medium and higher sulfur, the anode grade cokes. This is true in the green and the calcined coke market. We've seen month-on-month price increases, in fact, for the last 11 months now, highlighting the consistency and the strength of the marketplace in China, not just from demand, but also from constraints to the supply side. What has been notable is that the Chinese prices from an ex-works basis have led to a tightening in the export market. This shouldn't be surprising. Chinese export prices are important indicators for the rest of the world. But also China continues to operate the export market largely on a spot basis, leaving smelters, particularly those in the Middle East who rely on Chinese coke for their blends. It leaves them highly exposed to this volatile market. And in a rising price market, Chinese exporters are well aware that they can either silo material and sell it next month if they want a higher price, or they can sell it back into the domestic market. So GPC and CPC have maintained a premium throughout this period. In the last quarter, we've seen prices move from the mid 300s to the mid 400s, and offer prices now for anode grade 2.5 to 3% CPC are in the high $400 a ton for export coke, FOB China. So there is a major difference that's been taking place as well in World ex-China. In Q2 2020 and Q3 2020, World ex-China CPC calciners were really unable to pass on some of their cost exposure to the higher green coke prices due to one pretty clear factor, and that was aluminium smelters were unsure of what their order books would look like going forward. We hadn't seen the mass investment into aluminium, the pickup again in automotive demand and construction growth worldwide. And aluminium smelters also, while they were getting some benefit from the higher aluminium price, they were not seeing the huge margins that they've seen in 2021 and beyond. Therefore, calciners had to stomach very, very thin or even negative margins for anode grade coke in Q2 and Q3 last year. And we've been chasing our tails somewhat through into this period. And again, we've seen large increases quarter on quarter for European CIF Rotterdam, for Middle Eastern delivered, and for US Gulf FOB prices. We continue to see them moving higher again into Q2. CRU would expect Q2 prices to be the highest price point for this year. In fact, we think that we'll probably end up peaking with prices in around June. And the reason for that is largely to do with the lack of green coke that's been coming through into the market, the slight disappointment with the amount of crude that has been processed. The coker incentive simply isn't there. Green coke availability is very poor worldwide. There's very little slack in the marketplace, and calciners are having to compete for that limited supply. And if there's any supply disruption, it creates a huge problem. And so until we see that liquid fuel demand pick up globally, there's really no rationalization for this market where we'll simply see more green coke supply coming on. Therefore, calciners have to protect themselves and protect their margin. Another thing to note is that for the anode grade market, it's very rare that additional capacity will be brought back online simply due to what is a fairly temporary, in the grand scheme of things, price response. So we're not going to see any supply, additional supply coming online simply due to this short-term spike that will relieve market conditions for now. So what's happening is aluminium smelters are facing some of their highest costs simply from the carbon product, particularly the calcined petroleum coke, while in all other sectors they're seeing very, very low costs, whether it's their power costs being reduced or their alumina costs. So it is really sticking out as a sore point. So what's going on with the Chinese buying third-party green coke from World X China? This is something that's a fairly new phenomenon. Well, there's some key reasons for this, and it continues to happen, and it has done for the last 9 months, and I think will continue to, certainly for the balance of 2021. Traders who are purchasing World X China green coke, particularly low sulfur, and importing it into China, are offering favourable credit terms versus prepayment for calciners operating in China. We know that the oil refinery bottlenecks are consistently struggling in China. There has been some slight improvements with Asian jet fuel demand, but this is not significant enough at the moment to counter the really strong demand for CPC from aluminium smelters. So that is a genuine increase in consumption from aluminium smelters. And as mentioned previously, the premium for a ton of aluminium is so high for smelters that the importance is not the price of the CPC going into the anode, but it's ensuring that they've procured it so that they can maximize their output of aluminium. So right now, the worry is procuring, not price. In addition, we've got great quality specifications from World X China, particularly that of the material coming out of Brazil. Just from an economical perspective, the landed costs are still below that of the domestic ex-works prices, which shows you how high the ex-work prices are, despite the very high freight market at the moment. So what's happening is that green coke, which used to form a fairly important part of the World X China CPC raw material supply, is no longer available or is easy to get hold of. And if you want to buy that green coke, you have to compete with a very, very keen and aggressive buyer. And we don't see that situation changing. So going forward, market looks tight. Anode prices continue to accelerate higher in China. And what's really interesting is that the Aluminium plant in Europe has announced that they will close this year, and that is going to be the end of a third-party anode producer outside of China. There will be no more third-party anode production outside of China, and going forward, we can't see anyone who would be willing to invest in a standalone plant at this price point, and in these market conditions as well. So just in terms of the export prices here, they've risen by around $20 a ton month on month to averaging well over $700 a ton FOB China for the majority of contracts. The average price for Chinese anode exports has increased to a record high not seen for the last 4.5 years. We expect Chinese anode export prices to continue to move higher throughout the coming months. We've heard some offers as high as $850 a ton FOB China. So the market is tightening up into those summer months, but it is all a function of tight supply, strong demand. It's a real killer for the calcined coke market into these coming months. So if we just look here, aluminium smelter cost curves are signaling healthy margins, those producing primary aluminium. It's due to the low alumina price. As mentioned previously, it's around 11% of a ton of aluminium to a ton of alumina. And the high premium as well for the sales price of LME aluminium, nearly $2,400 a ton, or SHFE aluminium at nearly 18,000 RMB per ton. So therefore, the increasing focus has shifted from the cost component and cost escalation, namely the carbon anode, and more specifically the spiraling prices in the petroleum coke market. Now that pitch prices have stabilized and the outlook looks steady, the risk to the upside is starting to get limited. Concerns are growing that due to the issues in the green coke market, the prices for CPC could still escalate, but to what extent? And is there any comparison that we could make prior periods with a similar pattern? Well, if we look back to 2018, we can see that whilst LME aluminium prices set multi-year highs, the carbon raw materials were also completing their rally from the 2016 lows. Margins have been thin for calciners and distillers, and then some supply disruptions and limitations were kicking in, and the surge in demand for low sulfur, high-grade cokes fed through to those significant price gains in Q2 2018. So there is some precedent for some higher prices here, but as I said earlier, I do believe that we'll be waiting to see what happens in the liquid fuels market. If the coronavirus vaccination rollouts continue worldwide, if there are no second, third or fourth waves that are going to put a real hampering on travel, particularly international aircraft and the jet fuel consumption, then we may well see an easing. But for now, the coke market is pretty much prisoner to what's happening in the global macroeconomic environment. We have no way to stimulate the market, and for now aluminium smelters are able to pay extremely high prices and are willing to do so to ensure they get hold of the material. So the global balance, we have got some projects coming online in the Middle East, some additional capacity, and the same also in other Asia. Going forward over a 5-year view, we do have plentiful capacity in the CPC market. What will be of interest is, will any additional needle coke from the graphite and demand from the graphite electrode industry start to impact the anode grade market? We know that there's some switchable calciners that will have to make some decisions as those prices move forward, and also if the steel industry moves away from blast furnace and into more electric arc furnace production. But into the short term, certainly the market is tight, but it's primarily tight from a green coke perspective rather than a CPC perspective. So I just wanted to mention before I wrap up here, a couple of the things about the emissions in the value chain. And these are two conversations I think that need to be had, and certainly are starting to be had. Firstly, when it comes to the costs of emissions and being charged for emissions, it's still not quite clear how the carbon products industry will be applying the cost of emissions, how that we class a potential byproduct such as green coke or coal tar from a met coke oven, whether we are recycling that product. Do we have to own the emission from its production, or can we say that we are recycling it? Do we have to own that emission chain? And if so, does the consumer of our product, whether that's a calcined coke or a coal tar pitch, also have to take on that emission cost? So there's some analysis to be done here. Some policy also needs to be taken place, but it's something that will start to impact the industry steadily. And this is also why you hear talk of the inert anode, an anode that doesn't produce any carbon dioxide, carbon emissions. There is the ELYSIS process that is now going to a smelter, a pilot plant. We also see UC Rusal as well, producing around 1 ton per day of zero carbon metal. And so there is progress, particularly in these markets, and we continue to monitor it. To upscale it, there would be significant capex. We also need to see if there's any technical difficulties doing so. But the market is interested in this development, and I think it's something that policymakers and marketing departments as well will be keen to push forward. So thanks for that. Thanks for listening. If you have any questions, please do send them through either to the Q&A or directly, and I'll be very happy to answer it. Thank you for your time.